Welcome to the MLO SAFE Test Study Guide. Welcome. This presentation is designed to help you prepare for the MLO SAFE Test, a key exam for mortgage loan officers. We will walk through the essential topics, tips, and strategies to ensure you're well equipped to pass the exam with confidence. Whether you are new to the industry or looking to brush up on your knowledge, this guide will provide valuable insights and resources to help you succeed. Let's dive into the core concepts and important details of the MLO SAFE Test. RESPA, which stands for the Real Estate Settlement Procedures Act, was enacted under Regulation X in 1974. It's all about making sure real estate transactions are transparent. The law requires lenders to give clear disclosures about loan terms and settlement costs, helping borrowers understand what they're paying for. It also prevents shady practices like kickbacks and referral fees and places limits on how reserve accounts can be used. RESPA applies to loans for 1 to 4 unit properties, federally related mortgage loans, owner-occupied homes, reverse mortgages, and property improvement loans. It doesn't apply to agricultural loans, those on 25+ acres, business or commercial loans, temporary financing, or vacant land. When it comes to loan servicing, there are a few things that lenders must do. If they plan to place insurance on a property, they must notify the borrower at least 45 days ahead of time. They also need to respond to a qualified written request, QWR, within 5 days and work to resolve any issues within 30 days. If a borrower misses payments, lenders must try to contact them within 36 days and provide information on possible mitigation options by day 45. They can't file a notice of default until the loan is 120 days late. If a borrower requests a payoff, that must be processed within 7 days, and when the mortgage is paid off, the satisfaction notice must be sent within 60 days. RESPA Section 8 prevents kickbacks or referral fees for referring settlement service business. Violating this section can lead to civil penalties, damages, and even criminal penalties in some cases. If a company has an affiliated business arrangement, AFBA, they must disclose any ownership of 1% or more. Under Section 9, RESPA sets guidelines around title and escrow. If title-related provisions are violated, buyers can sue for treble damages, 3 times the amount. There are also specific escrow requirements, including a 2-month cushion at closing, and lenders must review escrow accounts annually and return any excess over $50 within 30 days. Lenders also need to give advance notice if they transfer servicing rights to another company. The borrower must be notified at least 15 days before the transfer, with details about the new servicer and any required actions. The Consumer Financial Protection Bureau, CFPB, oversees compliance with RESPA, and violations can result in hefty fines, including up to $10,000 plus 3 times the amount paid to the service provider, and in some cases, even 1 year of imprisonment. Mortgage professionals and settlement service providers are responsible for ensuring they follow the rules and provide accurate disclosures. As for disclosures, there are several key requirements. Within 3 business days after receiving an application, lenders must provide the Home Loan Toolkit for purchases, a special information booklet for reverse mortgages, HELOCs, and mobile homes, and a loan estimate or GFE for reverse mortgages, HELOCs, and mobile homes. Borrowers must also get a mortgage servicing disclosure statement and a list of HUD-approved counselors. Before and after loan settlement, there are also specific disclosures to be made. Before closing, an AFBA disclosure is required if there's more than 1% ownership, and the closing disclosure must be given at least 3 days before consummation. After settlement, the lender must provide the initial escrow statement within 45 days, an annual escrow statement, and a servicing transfer statement, which must be sent 15 days before transfer, with a 60-day grace period. TRID, or the TILA-RESPA Integrated Disclosure Rule, came into effect in 2015 to make the disclosure process simpler for borrowers. It does this by combining key documents into 2 main forms, the loan estimate, LE, and the closing disclosure, CD. However, it doesn't apply to all mortgages. For example, reverse mortgages, HELOCs, all-cash sales, and mobile homes that aren't secured by real estate aren't covered by TRID. The loan estimate combines the old good faith estimate, GFE, and the initial truth in lending disclosure, while the closing disclosure combines the HUD-1 settlement statement and the final truth in lending disclosure. This makes it easier for borrowers to understand their costs. When it comes to the Home Loan Toolkit, this has to be given within 3 business days of a purchase loan application to help the borrower better understand the mortgage process. Housing counseling is mandatory for high-cost and high-priced loans, including reverse mortgages, but it's optional for other federally related loans. Lenders must also provide a list of at least 10 housing counselors within 3 business days. A key form related to TRID is the 4506C, which lenders send at the same time as the loan estimate and the 1003 form. This form is used to request a transcript of the borrower's tax return from the IRS to verify their income. For adjustable rate mortgages, ARMs, the CHARM handbook must be provided within 3 business days of application. This handbook helps borrowers understand how the interest rates and payments on ARMs could change over time. There are also some important rules and guidelines with TRID. Lenders can't require borrowers to submit verified documents before providing a loan estimate, and they can't charge fees until after the borrower has received the LE, except for bona fide fees like the credit report fee. TRID follows a 3/7/3 rule, 3 business days to provide the LE. The borrower must receive the LE at least 7 business days before closing, and if the APR changes more than 3 business days before closing, a redisclosure is required. Fee tolerances are also a big part of TRID. There's zero tolerance for certain fees like transfer taxes, credit reports, appraisals, and loan origination fees. They can't change. For other fees, like recording fees and third-party provider fees from the lender's list, there's a 10% cumulative tolerance. The total amount of those fees can't go over by more than 10%. If there's excess, the lender has to return it to the borrower within 60 days. Fees like prepaid interest, insurance, and termite inspections have no tolerance limits, especially if the borrower chooses the service provider. Revised loan estimates are required if there's a change in circumstances, and the lender has to issue them no later than 3 business days after the change. Changes could include things like an act of God, like a tornado, inaccurate or changed information, like a low appraisal, or new information, like a previously unknown tax lien. Congratulations on taking the next step toward becoming a certified mortgage loan officer. We hope this study guide has provided clarity and a solid foundation for your exam preparation. Remember, success comes with dedication and practice. Stay focused, keep reviewing, and you'll be well on your way to passing the MLO SAFE test. Good luck with your studies, and feel free to reach out if you have any further questions or need additional resources. Stay confident, and you've got this.